So we're live today, and Josh, what are we going to be talking about this morning?
Well, we're going to talk about Canadian max mortgages and a market update. So some interesting things have happened. So,
Okay,
yeah,
all right. So let's get into
let's
it.
get into it. So, the purpose of the podcast and the Beat the Odds podcast is to help the average Canadian beat the odds at wealth, at building wealth, and I want to start because we're talking about max mortgages. We're talking about debt, okay, and using debt to build wealth, okay. And we posted a video a while back about, I went after Dave Ramsey. He's got a huge following, right?
Yeah, massive following. He's been doing it for years, and really close following in the religious circles. But yeah,
and I like to go there, and when you look through it, it's like when you go through something like Dave Ramsey, it's like you're going to get the Dave Ramsey disciples who are going to jump all over it, right? But like I just refuse. Like I refuse to give in to that, because if debt was bad, why does Dave Ramsey say you could have a mortgage? Okay, why is it like I just want to get into the hypocritical advice, right? And at its root core, when you start looking at Dave Ramsey's advice, it basically it boils down to telling the average person that you're too stupid to use debt, so you shouldn't use it. Not that it doesn't work. It's just that you're too. I failed at it. I blew up at it, and so obviously you're too stupid to use it too. So you shouldn't use it. Now, is that right? Are some people too stupid to use it? Potentially, right? But that's not what this podcast is for.
No,
okay,
no.
so if you think you are too stupid to use debt, turn off the podcast right now. Go watch Dave Ramsey and never take on any debt. Okay. But if you want to build your wealth, especially if you're looking at the trends, in Dave Ramsey's time, you could buy an average house with 6 years of median income, and now you're looking at 20 years of median income to buy a house. The inflation rates are different, the asset prices are different, and I think the wealth trajectory for anyone who refuses to use debt is vastly different, right? And so, I refuse to believe that the average Canadian is too stupid to learn this, okay? I just think that they weren't taught how to do it, and they can learn how to do it, okay? I'm a CPA. You got to go to school for 7 years to be a CPA. You got a 4-year undergrad degree, you got an article for 3 years, and then I've been doing this job for 20. So it's kind of a different perspective, but you don't have to be a CPA to learn it, okay? You just need to put in the time. It's not easy. It's not. You shouldn't be listening to someone out there who's telling you that on your $80,000 a year job that you should go out and get 4 or 5 mortgages and start renting Airbnbs. Like, yeah, that's incredibly risky.
Yeah, that's terrible advice.
It's how do we actually use debt responsibly, okay? And so, we're talking about the average mortgage. And so if this is for you, this is the channel. But I refuse. And when I see the Dave Ramsey disciples with their comments online, it's like, I just get excited. I'm just going to say more, okay? Because I'm not telling you what I think. I'm just telling you how I built wealth, okay? And I didn't build wealth by taking on zero debt. I took on debt responsibly, and I didn't blow up, okay? And, right now we're looking at an elevated interest rate. It's myself and, the vast majority of my clients, they're nowhere near blowing up, okay? Because you just have to take on a healthy amount of debt at the right rates for the right reasons and have a mixture of liquidity and assets, okay? You look at Dave Ramsey and how he blew up is he had illiquid real estate. All of his assets were tied up in illiquid real estate. Mm-hmm. So when the crunch came, he was well overexposed. He didn't have any diversification. It's like all of that were bad choice after bad choice after bad choice. Using debt was not the problem. Using too much debt was the problem. Not having liquidity was the problem. Not having a diversified income stream was the problem, okay? But using debt's not it. And the average Canadian is out there. It's like, yeah, you might not know how to use it, okay? But if you want to learn, it's like, this is for you, okay? This is the place for you. And I think the people who choose to learn this over the next 5 years, 10 years, 25 years have a better trajectory looking out for them. Because like I said, it's like you can't earn and save like you used to. And that's not me saying a feeling. It's just, the average house is, 20 years of median income instead of, 6.
Yeah, and that's exactly right, because the pace of inflation and asset prices are skyrocketing a lot faster than the median wage. Like, the wages are not keeping up with inflation. They're not keeping up with the cost of living. Mm-hmm. So, we have to have other options. And, case in point, myself, like, I've learned a lot just working together with you. And, I have an advantage over some people because I'm surrounded, in this atmosphere all the time. So I'm learning, my learning pace of figuring this stuff out is a little bit faster. But, if people just, pay attention to the channel, come to our boot camps, and, just listen and adhere to the advice, they can make it too, even in this economy.
Yeah. So let's,
let's see that. Drink the haterade here.
We'll drill into it. You can see the Dave Ramsey. Ramsey is not looking to help out large corporations. Neither are on this channel. It's like neither are we. Like, no one's going to help out their large corporation. It's like, yeah, they hire us for our CFO services. That's how we make our money. Not on YouTube. Okay. But this channel is for the average Canadian, a good starting point for your research and trying to learn and up-level your financial skills. Because without it, it's going to be challenging. I mean, you're looking at the historical, it all comes down to, what is the inflation rate? Okay. You look at gold and the performance of the last 25 years, like, you could have got 8% by just buying ounces of gold. You could get 8%. It's like, that is your real inflation rate. Okay. And now you start to understand that housing in Canada the last 25 years going up by 6%. Okay. So if inflation is 8 and gold is going up by 6, so if inflation is 8 and housing is going up by 6, you're under by 2. So if you don't know how to use debt, you're losing pace.
Yes.
And that is going to be, and that was not true when Dave Ramsey was 30 years old. The inflation pace was slower at that time. And so, there's 3 times as much debt in the system today. I was talking with some clients yesterday, and they were in their 60s. And they saw interest rates spiking. And they thought for sure, interest rates were going to 20% again this time. And they asked me, it's like, Josh, why didn't they go to 20% this time to curb inflation? And I had to tell them, it's like, when they went to 20% in the 80s, there was 3 times as much debt in the system. So a 7% interest rate that we went to this time was the same pain in the system as 21%, 40 years ago. Okay. Who owes the most money? The governments. And can they afford 20% interest on their debt? They can't afford it.
No,
okay?
they can't.
It was mathematically impossible. The system would blow up before 20%. Okay, could they go to 8, 9, or 10? Well, yeah, maybe. But were they going to 20? No chance. Like, no chance. You'd have Armageddon. Catastrophic. Financial failure. You have 2008 credit markets seizing up. It just wouldn't happen. It would seize up long before that, right? But people didn't understand it. They think times haven't changed. It's like, they have structurally changed. Okay, when you have 3 times as much debt in the system, it's when interest rates rise, it's 3 times as much pain. Okay, and so people have to learn how to use this instrument, and they have to know, where the likely trajectories of interest rates and debt are. Okay, so we'll get to the Instagram channel, and we always put these, like, the posted rates for the mortgages, and Trevor with Entrepreneur Mortgage Solutions, like, can we get better rates for clients than this?
Yes.
Like, with 100% certainty we can get it. And we put it up there for a couple of reasons. And sometimes people have to see this because some people are dealing with these rates in Canada. Some people are forced into these rates. They get a renewal letter from Scotiabank. They cannot requalify for the mortgage that they're in, and they have to sign the crappy renewal offer, and that's where they're at, right? Or they have less than ideal credit, or income sources, and they get forced into these crappy rates. But 100% in better situations, our goal is to always get clients better interest rates than these. But people have to be aware. It's like that's the interest rate some people are living with right now.
Yeah, that's true. And, like you can go to a mortgage broker. We have different options available, whether you're, self-employed, business for self person.
Yeah.
There's different options there that we can help you with for sure.
Yeah. So let me get into our chart. We put this out 8 times every year, and we put it out in conjunction with the Bank of Canada announcements. So the Bank of Canada, comes out and gives their announcement on interest rates 8 times a year. We re-put out the chart, and we start at $40,000 a year, household income of $40,000 a year. So someone with a household income, they can get a max mortgage, $178,000. Okay. Now, this might be saying, and it's a monthly payment of $1,018. This might sound like I'm on planet Mars if you're living in Vancouver or Toronto. It's like, what are you going to buy for $178,000? So for some people in the country, it's like, this might seem very, very odd. And I see the two.
You can get a nice 1-bedroom, 0-bath tent.
Yeah, and it's funny because I see the two extremes, because our offices in Canada are in Edmonton and Cole Harbour, Vancouver. Like it's like the polar opposite of the spectrum, right? Where our physical offices are located, right? And so it's funny when people think that maybe we don't. It's like we understand very well, because we're basically seeing the two extremes in our offices, right? But $178,000 is, you can get a 2-bedroom condo in Edmonton downtown for $200K.
Yeah.
And that will blow the minds of someone who's in Vancouver or Toronto. It's like in Vancouver, it's like you're hoping to get a parking spot for $170 for $200K. The parking spot might cost, it might cost $200K depending on the building you're in and where it is, right? And so we put this there because people know it's like, so if you're making, if you have a $20 an hour job,
yeah.
My question is like, why are you living in Vancouver or Toronto? It's like, this is always my question. It's like, because if you have a $20 an hour job, unless you're around the corner from a $30 an hour job or a $50 an hour job, and your income is likely to increase if you stay where you are. But if you're just at $20 an hour, it's like, man, you're going to be a rent slave forever in those markets.
Oh yeah, 100%. I mean, there's no way out for you, making that kind of a wage. You can go to, almost any place in Alberta. You can go to Red Deer, maybe not Calgary, but Edmonton, Grand Prairie. You can go to any of these smaller centers, and even in Saskatchewan, you can go there and you can definitely make a plan for yourself.
Yeah, it's a $20 an hour job. You can replace it, right? And so this is why I don't want to, have people, feel locked out. And sometimes when I tell people that, you can see like the guilt and the fear, kick in. They're like, they give you all the reasons of why they can't leave, right? And honestly, like when I read them, it's like they normally sound like bad reasons, right? If you don't have income, it's like, what about your family? And they're there, and I won't see this. And it's like, it's just like fear. You know what I mean? It's like at the root cause, it just seems like fear. It's like, okay, maybe your spouse has a high paying job. I get it. Okay, if one of you has a high income level, it's like, okay, maybe you're not going to leave that. I start to get it, right? But, if both parties are, call it $20 to $30 an hour, and there's nothing around the corner that's, you're not working for an employer or it's some sort of professional program where your income is going to go up dramatically, in the medium term, it's like, what the heck are you doing there? Because you can get on the property ladder somewhere else, right? And I look at, again, we look at, people, they start comparing rental rates to home ownership. And they'll immediately jump to, it's like, well, if you the minute you buy that condo, it's like now you have the condo and you got the property taxes and you have the condo fees and you're going to be higher. It's like, yeah, but guess what? That mortgage is going to be the same for the next 25 years. And if you rent that place, that's going up 6% every year for 25 years.
Yeah, that's exactly it. I mean, people aren't, thinking long-term thinking of using their, space to rent out a room or rent out the basement or have an income generating suite on that same property so that they can start building and generating wealth from that debt. So really what we're talking about today is using the debt in order to start building wealth and get on that ladder, right?
Yeah. And so like, I started at 40 because, most people, unskilled, laborers in Canada, it's like they can get to 20. They can figure it out. They start at 15 on minimum wage. They can figure out 40, right? You know what I mean? You don't have to have retraining in school to get to 20, right? Are you getting to $100K a year without some skills and getting better at something? No, probably not, okay? But you can figure out 40. In fact, you can just work some overtime at 15 and you can get to 40K a year. So this is attainable, and this is my point, is getting on, the program. It doesn't require high income levels. Do high income levels make it easier? Yeah, they make it easier, but, I've been doing this job for a couple decades now. I've seen a lot of people with lower income levels who've built, really good nest eggs and levels of wealth. And I've seen other people, 6-figure incomes for decades, and they got nothing to show for it. Like, zero is zero, man. Like it's just like zero is zero, right? And it's interesting because I just got back from the Philippines office and talking with the staff there. The interesting part is if I'm talking with 25-year-old grads in the Philippines versus 25-year-old grads in Canada, the 25-year-old grads in Canada have a lower net worth because they have a negative net worth a lot of times coming out of school. They got no assets and a student loan. And the grads from the Philippines, they got no assets as well, but they generally don't have a lot of debt. It's just not available to them. They don't have these crazy student loans. It's just not there. And so it's one starting with a higher income level, but as a whole, it's not unusual for one of our workers in the Philippines who we're there because we can get cheaper labor, okay? But it's not unusual for them to have a higher net worth than our Canadian grads here because our Canadian grads here often graduated school with debt, and that's just a system. And so you go back to the Dave Ramsey advice. It's like, was that the best debt to take on? Was that student loan for $100,000 to graduate with an arts degree? Was that a good idea?
Man.
And so you just have to understand, it's like, what is good debt and what is bad debt? If I can borrow at 4 and invest at 10 and I have no liquidity, concerns, I know that I can absorb a doubling of or tripling of interest rates. I know I can deal with a 50% income downturn. In fact, I know I could deal with no income for a year. It's like, how is the debt bad? How? Like, what's going to happen? The aliens are going to come down and increase the debt to 50%? Like, what is actually happening here? It's like, we have to understand, what could go wrong? Could you weather that storm, right? Because, for the situation where Dave Ramsey blew up and went bankrupt is it was fairly predictable, if you ask me. It's one income stream from the rental income, a whole portfolio of illiquid assets, and he just couldn't weather the storm. So, I mean, that's not a situation that I would recommend to
anybody,
anyone, right?
Yeah, no, nobody should take that advice or follow that path. Which I mean, okay, he's probably helped a lot of people. I mean,
yes.
Yes. It's not that he hasn't helped anybody, but his advice isn't for everyone, right? This here is a Canadian podcast for Canadian people dealing with our Canadian system, and the advice that you're giving can work for just about anybody here, right?
Yeah. I mean, if you're in small town USA, you can buy a house for a smaller percentage of your income that you can in major metropolis city in Canada. You can. You don't need the same number of years of median income to buy a house. Okay, so we have to, we do have to look at that. It's like, we're not taxed the same way either. And so, knowing how to use debt to offset your taxes, it's like, it's sometimes necessary in Canada on how we have to do it. They have one of the most common misconceptions is in the U.S. they have rollover provisions, and so when they buy rental property, you can essentially sell the rental property, and as long as you enter into another rental property within a prescribed time period, you can avoid the capital gain. It's like that doesn't exist in Canada. And we get a whole bunch of clients coming in because they've watched a bunch of TikTok videos or something, and they think that this exists as like, you've just been watching some American TikTokers. Like, this has never existed in Canada. For better or worse, it's like the Conservatives actually floated a rule, similar to those rollover provisions in the U.S., but it doesn't exist here, okay? And so now you have to realize, like, often you're stuck with properties in Canada. So you're stuck with properties in Canada as they deleverage. If you don't know how to leverage them effectively, it's like your rate of return, your return on equity, if you will, it goes down dramatically. So if you don't know how to use debt, it's like you're just at a dramatic disadvantage in Canada. You can't get out of that, single family house and get into a fourplex on your rental property without paying a tremendous amount of tax.
Yeah, that's exactly it.
You can't do it.
Yeah.
But you could extract the equity via a loan and lever up a new property, right? You could extract the equity and contribute to an investment account, okay? And even the investments that we get in Canada, the yields on dividend-paying stocks are dramatically higher. Okay, and so what interest rate you could absorb and be positive cash flow based on the dividend stream is entirely different. It's entirely different. And so I would suggest that Dave Ramsey's advice is becoming dated in the US, but it's dramatically less appropriate in Canada because of the taxation, because of the dividend yields available in Canada. It's dramatically different, right? Here in Canada, right? And so we look at this chart and we start to, get up to 60,000 a year. And you look at 60,000 a year, that is effectively about the median income in Canada, okay? At 60,000 a year, the max mortgage is $267,000, okay? Now that's a bit of that's a challenge if you're trying to get a single family house in any major market in Canada.
That's true. I mean, right now we are shopping for single family home, and I don't see anything in that price range at all. You can get townhouses and maybe a small apartment, but there's no single family home that's available at that price.
Yeah, and so you start to drill into it, and this is household income. So if you look at the income, if you have a husband and wife here, they're getting to $100K between a household. Not terribly out of reach for most people. Even 150, 120. That's two people median income. But I would suggest 100 is kind of doable. How are these calculated? Like, in Canada, it's 39%, right? So you can use 39% of your income basically for the house, okay?
Yeah.
So it's got to cover your mortgage payment, it's got to cover your property tax, it's got to cover your interest, and it's got to cover some utilities. They call it heat, which is kind of strange because why don't they consider the rest of the utilities, right? And then, of course, if it's a condo, it's got to cover 50% of the condo fees as well, too.
Right.
And, of course, they're going to stress test everybody at 2% over their contract rate, right? And that's 39%, of your income can be used to basically fund the house, if you will, right? And it's limited by 44% of your income to fund other debt. And that's right. One of the mistakes we see so many people make is their car loan.
Oh, yeah. Oh, my goodness. Let me tell you a story. Like, I'm trying to get loans for people, get the mortgages so that they can, use it to pay other debts or whatnot. And people, let me tell you, before you're going for a mortgage, don't get the $110,000 truck loan. Please don't. It just makes it so much harder to qualify and get somebody who's going to take you on. If you need to refinance to pay off some debts or do a remodel or something, my advice is do not get the truck loan first. Wait until after you have your loan, and then you can go ahead and see if you can apply for that truck loan. Because the banks will hand out a vehicle loan all day long, but qualifying for a mortgage, they're a little bit more stringent, a little bit more sticky on those things. So please wait before you get that dang car loan.
Yeah, I mean 44% of your income, and so if you got a small student loan and it's $100 a month, it's like that. A lot of times that's not gonna reduce at all what you can qualify for. You got $1,000 a month car payment. It's like it's effectively 5%. If your other debt payments are more than 5% of your income, that's now cutting into what you can qualify for, right? And so, it sounds strange, but you have people making $50,000 a year and they got an $800 a month or $1,000 a month car payment. It's like, well, now you got to rent. Now you got to rent until you can, get out of that car, and then they find out if they want to sell that car tomorrow, it's like they're underwater because as soon as they drove it off the lot, it was down, 10 or 20%, right? And so,
yeah. Recommendation for a car is like wait to get the loan if you can pay cash for the thing for something that's a little bit older, right? Don't get a brand new vehicle off the lot because you're gonna hit that. Going to eat all that depreciation right away. Wait for like 5 years so that thing is, any bugs that are in it are out of it and all the depreciation is gone and you're just, driving the vehicle. But don't get the loan right before you're wanting to apply for a mortgage, please.
It's one of the hugest mistakes. The other one where people don't understand are lines of credit. So they see a small payment on their line of credit, but they don't understand that the banks will consider 3% of the balance, right? They want to see as if you have to repay 3% of your balance, even though you're only obligated to make the interest payment. But you have a line of credit, it's like they're going to consider that payment as 3% of the balance, which is it's always higher than the interest obligation payment, right? And so that really cuts into people's ability to service debt. Right?
Yeah, and depending on the bank too, I'm in a scenario right now where they're actually looking at the entire amount that is available on the account as opposed to what the balance is.
They want 3% of the entire available amount, and they're going to consider that depending on some of the banks, right?
Yeah,
and
exactly.
So just having the credit facility open, that can really affect things. And so you look at $1 million house and $250,000 worth of income. And I see a lot of the fear porn posted online of people getting margined out. They're getting foreclosed on. And, it's almost always the same story. It's like they paid $200,000 over ask, and now they're, it's like, dude, why did you pay $200,000 over ask? And so the person, posting this out there is like, it's almost trying to scare the individual. It's like, you should be trying to scare the individual about paying $200,000 over ask, right? Because they got caught up in the euphoria of the market going up. And we tell people, it's like, I want all of the comparables in that neighborhood for the last 5 years. I don't want to pay the record price. And if that means I can't buy while the market's going crazy, I'm not going to buy. That's the market telling me something. I'm not just going to try to catch that rocket ship going up, right? And I probably had enough sense to do this, but I understand what it's like, right? Because I lived in Alberta in 2007 when the prices were just going through the roof.
Oh,
right?
man, it was bananas.
And I was younger, less experienced, and I felt that kind of euphoria, right? And I say it now, it's like, I would never buy. But at the time, I was considering it, right? But I just couldn't wrap my head around quite enough to do it. I was like, these prices seem like a lot. And what could I actually rent this thing for if I'm not going to end up living there, right? And I started to break that down, and then I didn't do it. But my conviction wasn't as strong today. So I could see, like, if I was just getting the wrong information, I could have become Dave Ramsey and bought 3 of them, and then I could have gone over the top and then be telling you it's not good debt, right?
Oh, man, you could have went bankrupt like he did?
And so, like, I made the right decision, but it was, like, it was, maybe it's kind of out of luck. You know, I could say it's like intuition, but I could see like just enough of the wrong information. You know, I wasn't dealing with the TikTokers telling you to get 8 Airbnbs at the time. Like maybe I would have made the wrong decision too, right? At that time when I'm less experienced. But I made the right decision at that time. But that's what people have to look at. It's like when the market's going crazy, the minute the realtor tells you, hey, you don't have time to do any comparables, put in a bid over ask right now, it's like, that's your red flag. It's like,
that's the time point. You need to step back and say, whoa, hang on a minute. Am I going to take my financial advice and my future into the hands of some guy who just wants to make a sale, right? Like his future is dependent upon me buying this thing.
Yeah.
And
then the other cases, these people, getting margined out is I look at that. It's like to get $1 million mortgage, they had to have $250,000 in household income. How many of those were mortgage fraud? You know what I mean? Like
oh man,
full stop. Some of those ones that are getting margined out right now, it's like how many of them had fake income?
Mortgage fraud is a big problem right now. Like the government is changing legislation right now surrounding mortgage fraud. Yeah. And there's a big announcement and training stuff going on now for mortgage brokers because they're having to, because it's very, very tough for people to, qualify. So they're fudging their numbers and providing fake, revenue and income statements, and it's become a big problem. So it's a real thing.
I mean, we're never going to get that. We're never going to get that number. We're never going to know the number. What percentage of the people now are going to get foreclosed on had inflated fraudulent income when they qualified for the mortgage to begin with? It's not a 0%, and I would be very comfortable going out on a limb and say it's not single digits. A number of the people who, because if you're only qualifying using 39% of your income and you're stress tested 2 points over, it's like something dramatic has to change in your life in order to not qualify. It's like you got to get laid off from the job, right? It's also the point where you have to understand, it's like your income. It's where are you in your career trajectory? Have you just got the biggest promotion and you got some crazy job with a tech company and all of a sudden you're making $200K a year? You've never made $200K a year. And if you get laid off from that $200K a year, there's no one else who's paying that rate. That's a pretty big risk, right? As opposed to, you're a second year HVAC technician. And in 4 years, in 2 more years, you're going to get your journeyman. Your income is going up. It's not likely to go down. And there's, a dozen different companies out there who would hire you at the same rate. And so you have to understand, it's like, am I right at the peak of the mountain? I got nowhere else to go but down in terms of my income level. It's like, well, yeah, maybe that's the point where maybe 39% can be even aggressive. But, for most people, that's not the case. Like, most people are going to increase their level of income. So if they legitimately qualify with 39% of their income, that's stress tested 2 points over. And so really it's less than 39% of their income. The probability of them getting margined out is pretty low. Like that's why the rules exist, right? That's why they made those rules. And so I look at the people, it's like, okay, they're getting margined out of their $1 million house in Toronto. It's like, did they really have $250K of income? Where did it come from, right? I would love to know that number. Of course, we'll never know, right? But the whole point is like, how do you qualify for that? And then the other point where we talk about it in the boot camp is various offsets that you can get. And so the offsets are important. The main one that most people don't think about is like a legal suite in your house. So a legal suite, it's kind of one of the hacks in the mortgage system in Canada. Is a lot of lenders can offset their mortgage payment, they can use 100% of the income from a legal suite. So whether that's the basement suites in Alberta or the laneway homes in BC or Ontario, they can use 100% of their income to offset the mortgage payment. And so that means the same person making $100,000 a year who buys a house with a legal suite can often, instead of getting $446, they can get $546. That's not an unusual scenario. And the laneway homes in other jurisdictions where the rental rates are higher, it's like you could get it's not unusual to see an extra $200,000. If that's something you can rent out for $3,000 a month or something like that. So that's a big deal, right? And then the other one is like people don't understand is like, how do they get to a second property? They can get to a second property because often they can offset the rental income, a portion of the rental income. Generally you're not going to get 70%. Think, 50 to 80%, depending on the lender you're dealing with. But you can get 50 to 80% against the potential rental income. So going from property 1 to property 2. Mm-hmm. This is why it's very, very important in Canada, right? Whereas, because there's really no provision. You can sell your principal residence tax-free in Canada still today. I don't know if that's going to be
as of this podcast on August 2nd, 2024.
I don't know if that's going to be forever. But like knowing this chart, it's kind of important, right? Knowing this chart's important. Knowing the potential offsets of rental income, whether that's legal suite income or true rental property income, what you can actually get offsets for, so you can borrow more money than what's here. But you also have to look at what am I borrowing? What's my income level? Is my income level likely to increase? And then the test I like to use is, what's your liquid assets? Okay, look at that monthly payment.
Yeah, let's take a look.
Look at that monthly payment, and the test I like to use is, do I have 24 months in that monthly payment in liquid assets that I can cash in? Okay, look at that. That's 24 months. Liquid assets. Think dividend-paying stocks, gold, and Bitcoin. Okay, do I have 24 months of that saved in that? It's like, okay, then the next is, do I have 48 months? I got 48 months. So that means my stocks could get cut in half, and I could still make those mortgage payments for 2 years. And so here's how, I guarantee you, when Dave Ramsey blew up, he didn't have 48 months of liquid assets saved.
No, otherwise it wouldn't have blown up, right?
He had all the liquid assets, okay? And so I refuse to tell the average Canadian that you're too stupid to learn this. It takes some work. It's harder than it should be. It should be easier to just earn and save, but unfortunately, the system is set up to move the wealth from the people who earn and save to the people who borrow to invest. And one of the easiest access to credit that the average individual in Canada can get is on real estate. The banks want to lend to real estate. It's terrible. It's like they should be more agreeable to lending to businesses, but they're just not financially rewarded to do so. We have a major housing shortage, and they just look at the risks of lending to a small business and the risks of lending in real estate, and it just doesn't make sense to them. And so they're going to lend on real estate, and that's where their preference is to be. Even in businesses, if they're lending to businesses, most of the businesses are lending big bucks to own real estate in that business, and that's why the bank is more comfortable to lend it, right? So we have to learn how to use these, study this chart, and learn how do we walk up the property ladder. And once you understand, it's like, okay, I can only qualify for a $200,000 place. It's like, okay, great. So now you have to learn to build wealth after that too. So you qualify for that $200,000 place, or you scrape together the 446, and you find a place with a legal suite, and now I can generate some rental income. It's like, okay, now you got to deploy that capital into something else that goes up, because the chances that you're going to earn and save your way up the property ladder, it's not going to happen, because those prices are going up year by year faster than your income.
Yes, yeah. There's no way that you can do that like realistically on like a regular salary.
Yeah, yeah. So we have that, and then we see the market updates here. I'll just touch on the big mecca. The Toronto is down 4.6%, and it's the tale of two stories. We're talking about the prices out west, and the prices out west are, especially in Alberta, like we're cooking right now. Like things are busy, property is moving, rents up, prices are up, influx of migration, but you can see the outflow here in Toronto. It's like they're down 4.6%, right? And you can see a lot of the larger centers in Ontario also a lot of red on that chart. Okay. So that is affecting, and someone who bought. So when you hear someone, they bought a house for 1.5 million and now it's only worth $1 million. It's like they bought the wrong house. Okay. Because really, if you bought a house for $1 million, it's like maybe it's worth 950 now, right? Like that would be kind of par for the course, right? And so you following those market trends, that's not so bad. It's like you have to understand assets don't go up in a straight line. That's not how this thing works, right? Most of the people with the 20 to 30%, it's like you start looking at what they did. It's like they bought it like hundreds of thousands over list, 4 hours after it went on the market. It's like, what were you doing, man?
No, like thinking,
what were you doing? But you have some empathy too, because I look at some of the advice that they're getting, right? And it's like they're trying to parse it together. It's like it's like real estate's going up forever, buy as much as possible. And you got, on the other hand, you got Dave Ramsey said never take $1 in debt, right? I don't know how they reconcile the fact that they can have some mortgages because they're okay with some level of mortgage. Like, man, debt is either bad or it's not, right? And so they're kind of admitting to themselves that there is a healthy level of debt, but they're not really explaining why, right? And so ultimately, we look at the Canadian market, and you can kind of see it as a whole. It's like we have a 1 month change in real estate, basically flat, 0.1%. Let's call that a statistical anomaly. But as a country as a whole, it's, we're down 3.6% in the real estate market over a 1 year. It's like, man, stop thinking in terms of 1 year. It's like you're trying to think, like, how am I trying to build wealth over decades? And when you buy places, like these are like my asset tests, and it blows people's mind. It's like my asset test, I've told people, I've developed this over time, is don't buy assets that you wouldn't be willing to hold for 100 years. Like I don't buy assets that I wouldn't be willing to hold. And that blows people's minds. It's like, I'm not going to be alive in 100 years. I'm not a vampire. I was like, I don't think that's going to happen. But do I reasonably think that my grandkids could inherit this asset and get some value from it, right? Do I think the property that I own, they can continue to collect some rental income on it? It's like, okay, that's important. Not, do I think I can buy a pre-con condo and flip it in a year because prices are magically going to go up? It's like, that's like, it could work, but that's an inherently risky transaction. Right?
Extremely risky. I mean, speculating on real estate, because you don't know what's coming down the pipe. You don't know what's going to happen, geopolitically or what happens with the energy prices and all of this stuff. So it's very risky. And I was going to make a statement earlier, like when we're talking about, re-upping real estate and investing in it, it's not like you're going to invest in real estate today and start earning some rental income, and then tomorrow you're going to get rental unit number 2. No, This is like a 10-year path before you're moving on to property number 2, depending on your situation. It's not like an overnight thing. So, when Josh is giving this advice, it's not an instantaneous thing. And because people are into the get rich quick, I want to make this move fast, I want things to happen right now. It's like, okay, you buy it and then you start building this nest egg out, and then when you're ready and you have it all set up 10 years later, then you can, refinance that house and get into, unit number 2. Like it's a path. It's a slow and steady path, but it's a sure path. I'd rather get rich for sure than get rich quick.
Yeah. I mean, we walk it through in the boot camp. It's like, how do we get to the second door? And we walk it through on median income. We're not walking it through on some high income, you got to blow up your business. Like, do we try to teach people how to blow up their business? But we also know that different people are going to have different skills in their business. Like, building $1 million business is very difficult. Not everyone's going to get a multiple six-figure income. It's like some people are going to have to make wise financial decisions on a median income, and we walk them through a path of starting out in a condo and getting to a single-family house in 10 years, and basically having 3 doors. And we walk people through that path in the boot camp. You start with that, the condo, the 2-bedroom condo. You can rent out the room in the 2-bedroom condo, and then you can buy the single-family house, with the legal suite after. And now you have, 3 doors, 1 that you're living in, 2 that paying you, and you walked up the ladder, with no more than median income. And it works. And it's slow, and it's boring, and it's get rich for sure, not get rich quick.
Yeah.
And it's not take on as much debt as possible, and it's not, never take on any debt. Debt is evil. It's a very predictable, high probability way to build wealth in Canada. And that is the key, right? In Canada. It's very Canadian specific. It's because our largest expense in life is going to be tax. And so if you have this American strategy that, might work in, small town USA, it's like, man, it's probably not going to work where you live, right? So you have to look for Canadian advice if you live in this country, okay? And oddly enough, it's like we can complain about the rules all they want. It's like, I wish it was easier to borrow money for a business in Canada. I think that would make our productivity numbers go up, but I have to learn how to play the game that I'm playing, right? Mm-hmm. And the game that I'm playing is very favorable to borrow against real estate. It's, I look at, we have our office set up in Dubai. Okay?
Yes.
So we have a company in Dubai, and I think the Dubai real estate, certain, pieces of Dubai real estate will likely increase in value quicker than the real estate I could purchase in Canada. I think I could get a better year-over-year return, okay? But the credit market is not as good there in Dubai. You can't have the same leverage. You can't have the same readvanceable products, and they're very restrictive as you get older. They basically want every mortgage paid off there by the time you're 65. Now, will that change in 20 years? Potentially, because 20 years ago in Dubai they didn't have virtually any mortgages. It was just evil and ungodly, right? So they changed the rules. But if I just look at it, it's like, I'd probably want to own I'd probably want to own some more real estate in Vancouver than Dubai. So when I look at that, it's like we complain about the bad things, but you have to forget about the complaints and just figure out where the cracks are, right? And the cracks are we have a housing shortage. We actually have a very robust credit market. It's not as easy to borrow money as it is in the U.S.
Mm-hmm.
In Canada. It's much harder, and that's why our mortgage delinquency rates are lower too.
Yeah, so I mean, it's harder to borrow, but I mean, there's a positive side to it as well.
That's right. We're a fraction of the delinquency rates, not just in. I think we posted a while back, and it's like it's less than. I think it's less than 0.5%. The mortgage delinquency rates in Canada, right? And for perspective, the U.S. is 1.5%, and the U.K. is 1%. They're a full double of where we are. And we're in Canada, we're still a third. Our delinquency rates are a third of where they were in the 90s, and so it's just a different market altogether. You take the entire real estate market in Canada, and you look at the entire mortgage market. It's roughly 35% loan to value. And that blows people's mind because they don't understand a third of the properties don't have any mortgages on them. We're several million units short. It's so is the housing market going to blow up by 50%? It's these people have to live somewhere. It's not like we have, a huge glut of real estate. And so, yeah, the people who are too highly leveraged, they'll get margined out. And then the other people who have money, as soon as the rental rates become attractive enough, they'll buy it and rent it back to them. That's what's going to happen.
That's it, yeah.
And so, we start looking at the market. But one thing I want to, we're going to look at here, and this is kind of a push to next week. We'll probably even relook at it next week is, we have Bitcoin had a nice rebound during the month. Basically, we'll call it the Trump effect here. I mean, what happened is that, Bitcoin spiked right after the assassination attempt. Like Bitcoin really spiked right after the assassination attempt. Trump has gone full Bitcoin. Of course, can he live between now and the next election? Will he actually get elected? And if he gets elected, will he actually do what he says? So those are
all good questions. Yeah.
I could very well see an event where, Trump does not win the election and Bitcoin's down 20 to 50%. That could happen. It's like you have to understand the asset that you're holding, but ultimately I think the direction, then I think people will wake up after a year from now and realize, even if it's down 20 to 50%, BlackRock won't stop buying. And eventually, I think the probability that we'll all look back and wish that we would have sold everything about Bitcoin is high.
Buy the dip.
That's not my financial advice. I don't have 100% of my assets in Bitcoin, but I also think it's kind of crazy to have a 0% allocation to Bitcoin. But we start looking at that, and then we look at the TSX. But remember, this is price appreciation, not total returns. So this does not include dividends. And why do I do that? It's because we're putting it next to housing, and I'm not putting the rental yield in there. I'm just putting the price. So if I was to put the TSX, including dividends, against housing without rental income, that's not a fair comparison. And they're taxed differently. And so we're going to continue to do that. But interesting what happened today. This chart is basically at the end of the month. But today, we're looking at is like these are the charts that I look at every single morning. And I like to look at the energy prices, and I look at oil. That's where we get the most of our energy in the world today is still oil. And so in my mind, it underpins the entire financial system down to $73 a barrel. Okay, I see that. What the heck is happening? You look at the S&P 500, it's down 1.5% today. That's a big amount for the S&P 500. Bonds, on the other hand, U.S. bonds up by 2%. That's kind of a flight to safety move. And I look at the U.S. dollar to Japanese yen, and here is here it is. Here's the chart. It's like this thing is down from 162 yen to the U.S. dollar down to 147. Okay, there's some structural changes here. Why I look at the Japanese yen is because it is the world's third largest economy, and they own they're the largest foreign holder of U.S. Treasuries. So they are the largest foreign holders of the long-term U.S. Treasuries, which also underpins the financial system. The U.S. Treasury market's the largest, most liquid market in the world, and the Japanese they're the largest foreign holder of those treasuries. Okay, you look at the Canadian dollar down to 72 cents. That's a big factor of the interest rate reduction, or so as you reduce interest rates, the attractiveness of the currency goes down. We have seen no cuts in the U.S. yet. But at the end of the day, we're 2 cuts in, and we're basically still at 73 cents on the dollar. Right? That's not so bad. If you would have asked me if we went twice before the U.S. went once, would we still be at 73? I probably would have projected something lower. So maybe, we've talked before. I probably wouldn't have cut twice in a row.
Yeah, I know. I probably wouldn't have cut at all.
But, if you would have told me I could cut twice in a row and only be down by a cent, well, that's not so bad. I think it seems like I don't even think the market, because potentially we could have 3 cuts because the Bank of Canada will basically give their next news conference first. They'll give their update on interest rates first before the U.S. Federal Reserve goes in September. They're very close. They're both in September, but I believe the Bank of Canada announcement is first. But so we could potentially get 3 cuts, and it's not looking like you could potentially have 3 cuts and maybe be 71, 72 cents on the dollar, and then I think the U.S. is very likely to cut, especially when I keep looking forward here. TSX also down 1.63%. Okay, so you can see all the risk-on assets are down, right? And this is a big one. This is the Japanese stock market. It was down 5.81% today.
Wow.
5.81%. And it's like, these sound like small numbers, but I want to give this context. The third largest economy, this is the third largest economy. It's down by almost 6%. That is the largest single day drop in the Japanese stock market since 1987. So that is, We're talking almost 40 years here before it's gone down that amount. Okay, why did that happen? Okay, so we drill into why it happened. This is what the interest rates were in Japan, okay, over the last 10 years. And you can see they've been at 0 or less than 0, okay?
So money is cheap.
Money is cheap. Basically, the banks are getting paid to take the money, okay? It's kind of it's not a lot. It was 10 basis points, right?
Sure,
it was
sure.
at 0. But then you can see they increased by 20 basis points to 0.1. And not a lot really happened, but then they increased to a quarter on July 31st, and that was enough. So they increased to a quarter point, and that sucked the liquidity out of the system in Japan. And people don't realize, they think like, oh, it's Japan. What do I care about Japan? It's like, there's something called the carry trade. And the carry trade is, people, investors in Japan, individual investors, institutional investors, even the Japanese government. It's they get money cheap, and then they can send that money abroad and earn a higher interest rate. Okay, but as Japan increases their interest rate, the attractiveness of doing that. So that doesn't just suck liquidity out of the Japanese stock market. That sucks liquidity out of every major stock market in the world. That's a big deal. And so we're going to see how that unfolds between now and next week. It's like, is that the quarter point? But that really further, I think, probably increases the odds that the U.S. will cut in September. And it looks like the Canadian dollar is going to be pretty resilient. I think the only thing where maybe we would see like a mass change is like if the U.S. does not cut in September. So I think, the Canadian dollar is kind of treading water. It's down slightly just because they think, okay, yeah, Canada has cut a couple times, but the U.S. is likely to cut in September. And I still think they talk. And so, I still think they talk. I think there was the one where Jerome Powell, head of Federal Reserve in the U.S., he got pranked. And there's like a Zoom call of him talking to a prank caller because he thought it was someone real. So if he's talking to the prank caller, you got to think he's taking calls from, other central bank heads around the world. So, I'd be surprised if the U.S. doesn't cut in September. But is it a guarantee? It's like, yeah, you never know.
Never know, right? That's why you can't make your decisions based on what might happen. You have to make decisions based on what's happening today.
Yeah, and in the short term, everything's a risk. Yeah. But in the long term, you look at the trends. It's like, where are interest rates going? Well, interest rates are probably going right back to where they've been, which is a prime rate of 4%. 4 to 4.25. That's what been the average prime rate for 25 years. And when I'm buying real estate, it's like, yeah, that's probably that's my prime rate that I'm going to be dealing with. And that's where, if the decision, kind of makes sense to me. I'm buying an asset that likely goes up by 6, and it's going to cost me 4 to buy. Okay, good.
Right, sure.
I understand that, right? And it really is that simple. But it's only that simple if you have enough liquidity and you do it at the right levels, right? It's not you can't buy it at a quarter point either way. Changes your investment decision, because this is something, like I said, you buy a piece of real estate, you take on a mortgage. It's like, if you take on a mortgage, you want to hold it for 100 years. Could I buy this and either A, I'm going to live in it forever. This is the trophy property that my family's never going to move out of, or B, yeah, I am going to move out of it someday, and I could generate some rent on this. Maybe it's not the best rental yield I could ever get, but yeah, I could collect rent on this forever, right? And that's been kind of my perspective. And I have a strange real estate journey, and people understand. I've actually never sold any real estate, and that's I own a bunch of real estate. I've never sold any. It's like I tell people, the game's Monopoly. The game, you don't win Monopoly by selling your real estate and buying new stuff. You win Monopoly by getting more and more doors. It's like, that's how you win the game. And, why do I do this? Because I don't pay any tax, right? It's not unusual. I look at people, it's like, yeah, you could get out of this underperforming piece of real estate because you don't think it's a high of yield. You can get into this other investment, but after tax, it's like, it's at least 10 years before you break even. That's if everything works out. If everything works out like you think, after you take the tax hit, sell it, pay it, pivot into this other investment with a higher rate, it's like it's going to be 10 years before you would break even on that trade. And so, this is the goal. So understand those mortgage rates, understand your ability to move up the property ladder. And I would say, as a Canadian, think long and hard about adopting advice from anybody who says to take on as much debt as possible, or someone who says take on no debt, because in my mind, both of them are equally detrimental to your future wealth.
Yeah, definitely a recipe for disaster. So with that, everybody, pay attention to the podcast. Thank you so much for joining us today. And if you're interested in making some more money and learning more about business and wealth in Canada, stay tuned to the channel. Don't forget to like and subscribe, put the notification bell on, and you're welcome to join us at any of our boot camps. The next one's coming up in November. You're welcome to join us. You can get tickets online at spurrell.ca and click on the tab that says boot camp. Thanks so much.
Nice.
All right.